Welcome to Vital RE, where we talk about real estate, mortgages, and everything in between. If you're new to my channel, please subscribe, hit the alert button so that way you will get notified every time I release a video. Don't forget to like this video if you find it useful. My main purpose is to serve you. What do I mean by that? There's a lot of YouTubers out there, there's a lot of channels out there that you can be wasting your time at. I'm here to give you the information that I know, the information that helps me day by day. And today's goal is to be talking about the MBS market. What is the MBS? MBS stands for mortgage-backed securities. So what is mortgage-backed securities? Before I get into the details of what it actually is, you've probably heard the rates go up and down, every day, every week. A very heavy subject. As much information as I can from you. When it's time to lock the loan, we're going to have a conversation. Hey, it's time to lock this loan. We're going to lock it for 15, 30, 45 days, whatever amount of days it is, we're going to be locking this loan. After we lock the loan, that particular rate is guaranteed. Doesn't matter what happens in the market. Doesn't matter if the world crashes. This particular bank or investor has guaranteed that you're going to get this particular rate for this amount of money. So I locked the loan. We closed the loan. As mortgage brokers, you're never going to pay us. We're in a month or so, we're going to ship If you've never heard of these, whatever, it doesn't matter. You know who your mortgage servicer is, and whenever you do a new loan, whoever you're working with is not necessarily who you're going to pay, unless you go to the bank, but big banks like Wells Fargo or US Bank, then they're probably going to service their own loan. After you get that first bill and it's time for you to pay that particular servicer, it's not as simple as that. It's not as simple as they're your bank. Although you're paying them, they're actually only servicing it. When I make the loan and I sell it, or my particular firm sells it to this investor, it kind of bypasses and goes into the servicer. The servicer will collect monthly dues, fees, whatever, but when this loan gets passed on, my brokerage gets a fee. That's how I get paid. That's how my firm gets paid, and we're done with that. We forgot about that loan moves on, whatever. Now, whoever's going to be holding your loan, whoever you're going to be paying for, I guarantee you they probably won't hold it for the next 30 years if that's what your mortgage is. Most likely they're going to dump it. And if you've ever had a mortgage, you probably got a notification saying, hey, your mortgage got transferred. You're like, what the heck is this? What that means is one bank or one investor is able to transfer that loan from one spot to another loan. A mortgage is made, mortgage is sold to an investor. That particular investment actually gets a bunch of different loans. And that's why we call it a conforming loan. Every single mortgage that we create, they have to go follow the guidelines. And because when we sell, say 100 of our mortgages to Penny Mac or Mr. Cooper, they need to be exactly the same. What does that mean? We need to follow the same exact conforming guidelines. That means if it's self-employed, we're checking A, B, C, and D, or W-2 employee borrower, A, B, C, and D. Guidelines are very different. We're going to follow those guidelines. So when Mr. Cooper or Penny Mac receives the loans, and we'll ship them off in a bunch of 100, 200, they're actually going to create what's called an MBS packet. Now this is where it gets a little investment bank. They're going to create something that's an MBS packet, a mortgage-backed security, that then they'll go ahead and sell it to investors. You're probably asking, oh, whoa, I'm already lost. The best way I can explain it to you, you go to the bank, you create a loan. Whoever you create a loan with gets rid of that loan ASAP because they want to make more loans. So whoever gets the loan next, they need to figure out, what do I do with it, right? So what they do is they find people on the bond market. And who are those people? They're investors just like me and you. So then they dump it. When they dump it, they can again go reinvest. They can go get that another packet of loans, and then they can go package it out. The big question is, who actually holds the risk? Me, when I'm creating that loan for you, or the bank that I'm selling? The more faith people have in these mortgage-backed securities, if everybody in the world just goes in there and starts buying these bonds because they believe that these mortgage-backed securities are worth something, what do you think is going to happen with the mortgage rates? They're going to drop. Why are they going to drop? Because more people are buying it. What happens if people stop believing in these mortgage-backed securities and they start selling them? They're going to go and start buying stocks. Maybe Tesla, maybe Ford, who knows? But they no longer want mortgage-backed securities or these mortgages, rates will go up. Now, I will make a video on how the Fed and how some of these news affect mortgage-backed securities and why the spike happens. But at the base level, you just need to understand how rates work in general and how cost of those rates work in general. When people are dumping the mortgage-backed securities as bonds and they don't want to hold that paper no more, rates will go up. Simple as that. The pandemic and the crisis, we were seeing good interest rates. Why? Because the Fed was buying these bonds. They were trying to control this bond market. But then the time come and they're like, we're done. We're going to dump this crap. And they started dumping, they're offloading. Rates started increasing. Let me give you a really quick breakdown of what happened in the last about a week and a half. And then we're going to wrap this up. So today is August 7th, 2022. And today happens to be a Saturday. The market is closed. Not last week, but the week prior to that, and I'm too lazy to look up the actual date, the MBS market was doing great. So on daily basis, every time the market goes up or down, we call it the basis points or, MP, whatever. So not last Friday. Okay. 29th of July, we had a plus. We had a green light on the MBS market. We were up 20 basis points. A couple days prior to that, we were also in the green. So then came Monday, which is August 1st. We were up 13 basis points. So what that means is, again, every time, that means more people are buying. They're interested in in that paper, and the interest rates are dropping. So things were doing great. So what happens if, let me just rewind just a little bit. Anytime you lock a loan, it's guaranteed for 30 days. Sometimes 15, sometimes 45, whatever the amount of days you lock the loan for, it's good. Doesn't matter what happens in the market. I'll create a video one of these days where we talk about how to lock a loan, how, what is that? What does it mean to lock a loan? But as soon as I lock the loan, and typically if it's a purchase, 30 days, doesn't matter if the world is burning, doesn't matter what happens to the bond market, the investor is saying, whatever happens, I'm taking the risk, you're taking the risk, for 30 days you're safe. So that's why we try to close in 30 days. So here's one, this is a very live example. A loan was locked for 30 days, the lock was expiring. We had to do an extension on the purchase by 8 days. My lock is expiring, the market is being a little wobbly. Do we try to extend it? There's a fee to extend it, or you can let it expire and relock at whatever the market is at that time. I had that loan locked for 6%. It's a purchase, 1 unit, 6% primary. And fees wise, it was around $150, under $200, right? In today's market, it wasn't bad. In the 30 days before the expiration, it was as high as a 6.5, close to par. Then it was back to 6.25, etc. So lock is expiring. So I decided to let it expire. As it expired, it's time to relock. So it expired on Monday. And come Tuesday, the MBS market drops 81 basis points. What 81? That's quite a bit. I mean, if you watch the MBS market, every day it's like plus 10, plus 13, whatever. This particular week, there's a lot of news coming out. And news affect the bond markets as much as Tuesday morning at 11:21 a.m. I log in and I take a look at what's going on. There's a big drop, but the market or the actual rates haven't made the change yet. So I log in and I actually see an improvement because from the previous days we've seen an improvement, and I see an option for 5.625%, and it was going to cost about $162. So if you're buying a house and you locked 6%, and all of a sudden you have the opportunity for close to similar amount of money to be able to be locked with 5.625%, that's, if the max loan amount is about 647, thousand, that's about $150 worth of savings every month. So in this particular example, 5.625 was a good damn deal for $162. And this was at 11:21. Trying to get a hold of the borrower, trying to lock this baby in with a matter of minutes, in this case around 20 minutes. At 11:43 a.m., that 5.625% option was now $34.88, around $3,300 difference. So either you're paying $162 to lock that loan, or you're paying $34.88 or $3,488 to lock the loan. Within 20 or so minutes, that's what the market does to you. It gets worse. In that same day, at around 12:07 p.m., that same rate of 5.625% is now $49.19, which is $4,919. That's insanity. We're able to lock that particular buyer or borrower at 5.625% because after we do the math of all the extension fees, what 6% versus this particular percentage, it still made sense to lock him. And under $3,500, he's gonna make his money. We talked about what the MBS market is. We talked about the bond market. We talked about how volatile it can be. We talked about if you locked your loan, you're safe for about 30 days. But if you're nearing expiration, you have to figure out what you want to do. These can be very tough decisions to make. At the end of the day, we're always going to do calculations. Is it worth saving a couple bucks every month? In this case, $100 or $150 every month to lock a certain rate and put a little bit more money up front. I hope that you have found this video